Let me ask you something. Could how you define inflation have a major effect on your financial security during this time of economic crisis? How about if one definition of inflation could show you whether your net worth went up 20% or down 20% or whether it plunged 94%? How about if the other definition takes those same three circumstances but is incapable of distinguishing whether your net worth goes up or goes down? I recently debated well-known blogger Mish Shedlock, and he was having trouble understanding the practical implications of various definitions of inflation and deflation. So I thought this would be a great opportunity for an educational video that could really help a lot of other people out. Because what inflation does to your net worth is anything but theoretical, and you can't afford to be confused by theoretical discussions. Let's start with Mr. Shedlock's views, and we'll call them the norm. As taught in Economics 101, the definitions of inflation and deflation are fairly straightforward. Inflation is an increase in the money supply. Deflation is a decrease in the money supply. Unfortunately, that's where the straightforward part ends. Just what does money supply mean anyway? Is it M1, M2, M3? What about credit? What about the value of real estate and other assets? And for the average person, what do those M's really mean anyway? Once we have somehow picked a definition for money supply, what are the practical implications for you and your savings? Unfortunately, that's another problem with these theoretically correct definitions of inflation and deflation. Any linkage between our definition of inflation and actual price levels, like the price of your groceries, is highly theoretical. Some economists will write papers saying one thing, some economists will write papers saying the opposite. It's the perfect subject for debate because it's unsolvable. Now, let's move from theoretical economics to investment decisions in the real world. Speaking as a CFA, MBA, financial author, and former investment banker who has worked with dollars by the billions in the real world, one of the core principles that permeates professional finance is that a dollar isn't a dollar, not at different points in time. To make real-world investment decisions, we use rates to compare dollars at those different points in time. We usually incorporate inflation into our discount or compounding rates, at least implicitly, with the most common number that we use for inflation being the changes in price levels, like the cost of your groceries. In other words, often the consumer price index. So from a finance perspective, the perspective of applied wealth management for the most sophisticated investors in the world, I think it's fair to say that they generally use the definition of inflation as a change in price levels rather than some theoretical definition that's too ambiguous to ever really pin down in practice. So what's the difference between these definitions for you? Why should you care? We'll start with an Econ 101 perspective. The money supply, however we define that, went up. More money sloshing around the economy means prices rise. Our asset was worth $100,000, now it's worth $120,000. So that's inflation by definition. And that's pretty much all we know. Now, let's come in from a practical finance perspective. We started with a $100,000 asset and we end up with a $120,000 asset. This asset could be a house, stocks, comic books, whatever you want it to be. The dollar doesn't change in value. Since a dollar started out being worth a dollar and ended up being worth a dollar, we end up with an asset really worth $120,000. That means our net worth went up 20% as shown on this graph. That's great. But what if we define inflation not in terms of money supply, but what a dollar will buy for us? Isn't that the part of inflation that most people really care about? What it costs to, I don't know, buy things? Okay, we have exactly the same situation from an Econ 101 perspective. We start with an asset price of $100,000 and end with an asset price of $120,000. Indistinguishable from our previous example. Only this time, we have inflation in the sense that most people mean it. A dollar becomes worth only 67 cents in purchasing power terms. So if we can sell our asset for $120,000, but each of those dollars in the future will only buy what 67 cents does today, what's the real value of our asset? I would say that it's obviously $80,000. So when we look at our graph, we start with the bar on the left, which is 100,000. On the surface, it looks like we go to the bar in the middle, which is 120,000. But when we account for dollars being worth less than they were before, the real value of our asset is only $80,000. The difference between the $80,000 and $120,000 is the fire of inflation. So when we use the Econ 101 definition of inflation, we're unable to tell the difference between gaining 20% and losing 20%. Interesting and a bit troubling. And what makes it even more troubling is, what if the dollar drops to a value that's much lower than 67 cents? Okay, exact same situation from an Econ 101 perspective. Starting asset price of $100,000, ending asset price of $120,000. Only this time, a dollar ends up being worth only 5 cents. So if we can sell our asset for $120,000, but each dollar is only worth 5 cents, what happens to the real value of our asset, its purchasing power, what it will buy for us? It dropped all the way down to $6,000. Our left and middle bars are just the same, but look at our right bar. That $120,000 is almost all inflation because we lost 94% of our net worth. We lost 94% of the value of our asset, which is asset deflation in purchasing power terms, but it was entirely hidden by the 95% destruction of the value of the dollar. So, 3 scenarios. In each case, we start with the same price, we end with the same price, but we have 3 radically different outcomes for our net worth. Now, if you take what some people consider to be the smart route of using a theoretical economics definition of changes in money supply, those outcomes will be impossible to tell apart. However, if we use a methodology specifically designed for practical, real-world investment decisions, then these differences become boldly obvious. Unfortunately, many millions of people are paying a tragic, real-world penalty for this clash of definitions and jargon. The first price is that if you or your advisor can't see the difference between gaining 20% and losing 94% of your net worth because of the definition you choose, then you are investing blindly. The second price is confusion, and this one is nailing many millions of people right now, as well as confusing the heck out of many commentators who are using simplistic definitions. People think that because housing prices and stock prices have plunged, that the value of their money is protected. This belief is dead wrong and profoundly dangerous for investors. When a nation gets into economic trouble and it has a symbolic currency like the current US dollar, then the historic norm is simultaneous asset deflation and monetary inflation, where the value of your money and the value of your assets are destroyed simultaneously, as I explain in my other writings. This last one is the worst of the bunch. There are a whole set of innovative, practical, historically proven solutions which are out there, but people can't act on them because they can't see the real problem. If you can't see what's going on because you're blind and confused, then you have no chance of protecting yourself, and that's a tragedy. A tragedy that does not have to happen to you. But to avoid it, you're going to need crystal clear vision. If you've learned anything from this short video, and you would like to learn more about how to see clearly the problems that are coming at you and potential solutions to meet those problems, then I would encourage you to read a free book that I wrote on that subject that's available at my website, DanielAmerman.com. Good luck to you in these difficult times.